this is the market breadth. I shared this in the previous session, probably 1 or 2 times before. Very much that I think we definitely have a lot of the different type of the interpretation with the market breadth. In this chart, I'm using the percentage of the stocks above the 200-day MA. So this is quite a nice chart. Previously, I shared about the divergence, which is still diverge at this point of the time. You can see that it's just forming a higher low for the S&P. Now the market breadth is in a downtrend, lower high, lower low. So definitely it's in a divergence, not a healthy market. But tonight, the point that I would like to get across is this. We are definitely in a market correction at the moment, or a strong pullback. But the key is, would it continue, or would it sort of like we reaching the bottom already? I think that's the major question that a lot of people are keen to find out. So apart from just looking at the chart, the price action, the volume, I think we still can rely on a market breadth to just derive the bias. So let me show you how I will interpret this chart. So pretty much that I just use these 3 lines, like 70%, 50%, and 30% to just separate the level. So very obvious, I think this is kind of like the overbought 70%. So if the percentage of the stocks above 200, the MA is above 70%, means that you can imagine that there's more than 70% of the stocks in the market that are still above 200-day MA. So very much is very bullish. So it's in a very bullish environment. So you can imagine that a lot of the stocks participate in the uptrend. And so I think this is a very bullish sort of the uptrend. And anything between 50% to 70% is still good. So I think this is quite normal. This sort of the market condition within 50 to 70% is very normal, because in a bull run, we don't really need every single stocks to participate. So if there are more than like 50% of the stocks participate in a bull run, means that 50% of stocks above the 200-day MA, I think is still a very healthy bull run, very healthy uptrend. But the key point to actually interpret this is actually to look at the context. So every time that when the market breadth actually dip below the 50% level, so for example, I just circle in blue. So there are first, second, third, and a fourth. So every time that it did below the 50% of the level and fail to get back up. So if you take a closer look, you might argue that, well, I think this is a dip, right? This is another dip, another dip, another dip. But in Wyckoff term, there's a term called spring. So it's just a temporary commitment and then followed by a very quick recovery. So this is just a spring, a spring, a spring. So there's no commitment below the 50% of the level, unlike this. So this is in the 2014. So there is certainly commitment below. And this is spring, this is spring. And here in 2015, there is a dip below, followed by an attempt to rally up, and then another attempt to rally up. So it still shows the inability to rally up. So there's weakness, and it just failed to get back above the 50% of the level. And again, this chunk here. So this is a bit messy, but definitely what I'm referring to is that when the market breadth actually comes down from above. So we need the market breadth coming down from above, not to rising up. So this is rising up from below. So this doesn't count. And in the COVID sell-off, this is definitely coming down here. But if you really want to argue with this, but this is kind of a choppy session. It's like going down from the bottom and then coming back up. So this is certainly is not valid. So that's why I just use this for example. So one is in the COVID sell-off, the other is in the 2018. I think there's a Christmas sell-off, and then in the 2015 and 2014 as well. So when the market breadth actually dipped below the 50% level and then failed to reclaim the 50% level, there will be a trouble ahead. So you can see that right after this, there is a continuation to the downside, and most likely it will just dip below 30% as well. So 30% is like the oversold level, or you can call it the capitulation line. So it's just kind of deeply oversold. And when it reach this oversold level, what we can expect is some form of the bottom, but that definitely need to look at the price action. So in 2014, let's just focus on this green highlight here. So there's a green highlight of the bottom. So there's a green highlight here. So you can see that it just aligned very well. Whenever it just hit went into the oversold, like below the 30% of the level, it just coincide with the market bottom. So when it turns, this is a rally. So another rally, this is another rally, this is another rally. So that is pretty much coincide with the market bottom, at least in 2015, and also in the COVID sell-off as well. So when there is, this is so extreme, you can see that it's just below 10. So there's less than 10% of the stocks above the 200-day moving average when it's at the bottom. So you can see how bearish it is. So the idea is like this: when it's reached the extreme level, like for example, this is 10%, only 10% of the stocks above the 200-day MA, and this is like, well, also close to 10%. So it's just quite extreme. And when everyone is so bearish in the market, so who else is left with the bearish view? So everyone bearish have already sold their share, already short sell, so close their long. So there is not many people left that's still bearish. That's why you see this kind of the automatic rally. This is also another automatic rally. So this is like when the stock reaching the oversold condition. So below 30% is considered as the oversold condition. So in 2018 is quite a exception, because this is a dip below the oversold 30%, followed by a recovery. But look at this. This is still in the middle of the big range here. So, but in a short-term view, we still see an upswing from the bottom to the top. So this is still an upswing for the S&P 500. So I think we need to just pay more attention to this kind of the oversold level. Right now, we are at about 31.3. So it's very close to the oversold level, but still, when it failed to reclaim this 50% line, there's a chance or high chance that it will just dip below the 30% level. So it might not be as mild as like 20% as we see in the 2014. Could be just 20%, could be 10%, 10%, or even below 10%. So it's just depend on the market. But that's what I believe, that we need to see the oversold level of the market breadth together with some kind of the capitulation of the S&P 500. Then I think we can probably consider to take the long side of the trade. Okay, so that's how I actually interpret the market breadth to actually justify, get a feel of the market, whether the sell-off has legs to go, apart from just by looking at the charts. So eventually we still need to look at the charts, which I'm going to jump to the chart right now. Okay,